cash value questions. So today we are going to answer two very popular questions in respect to cash value life insurance and how to maximize it with a whole life insurance policy, which are: how long can I fund a policy and how long should I fund a policy? So first part, how long can you fund a policy? And then how long should you fund a policy? Well, to provide a quick answer to both, how long can you fund a policy? As long as you want. It does depend on the company and product, but you'll see a lot of products called a paid up at age 100, life paid up at 121. And what those numbers represent, for example, life paid up at 100, that's how long you can pay into the policy age 100 if you wanted to do that. And not many people do that, but if you wanted to continue to feed the policy, I like to refer to it as feed the beast, you can continue to pump up the value over time. And at the same time, you can fund for 2 or 3 years if you wanted to. We've looked at lump sum studies on that in the past. But the next question, how long should you fund a policy? And honestly, that's up to you. That's a matter of preference. You may say, hey, I really like the idea of cash value life insurance that, hey, I can put my money here, it's safe, liquid, tax-free, no risk there, it grows, call it between that 3 to 5% internal rate of return, and the death benefit is paid out income tax-free. So if I continue to pump money into it, I can leave this large legacy to my beneficiaries, and I am attracted to that idea. Or you might hear that and say, I don't really care. I am interested in the benefits of the cash value. I've got a lump sum of money. I want to pay into it for 5 years, maybe it's 10 years, then I'm done. After that, I don't want to be obligated to pay a penny into it. Maybe I will continue to pay a small amount, the premium, but hey, I don't want to get a bill for anything by the time I hit this certain age or after 10 years. Depends on your preference at the end of the day. And then, of course, the third option here, as far as how long should you fund because it's a matter of preference, the answer could be, I don't know. I'd love the ability to stop after 5 years if things really go south, but if things are going well, can I continue to add to the policy? Or do I have to take out a new policy and go through the initial insurance expenses again? That's a whole nother conversation. So we're going to look at some examples today. We'll have some fun with this. But really some things to consider here, or things that are critical, I should state, is first and foremost the company and product. Different companies and different products have different advantages, period. For example, if someone said, hey, I really like the idea of paying in as much money to this product as long as possible. I want rich cash value up front. I want the strongest cash value long term, and I want to be able to pay into it for 50 years or something like that. Well, as we assess the different products, MassMutual's product and what you can do with their design will really accommodate that particular type of goal. I want to be able to pay into it for a long period of time. But if someone said, hey, I want to be able to max fund this thing for the next 10 years, or by the time I hit 60 and I'm 55 right now, so it'd be 5 years. Well, in that case, looking at a guaranteed and non-guaranteed cash value, internal rate of return, Guardian's product is phenomenal for that. And both companies and products can do the reverse, but just when you look at what is most favorable, those are the little things I like to be aware of to know, how do I just maximize the consumer's position? This way they don't run into an issue and think, I should have gone with option B, but it was not shown to me, it wasn't proposed, because there's so much information. And if you're an insurance nerd like me and think this stuff is cool, then you know what I'm talking about. Internal rate of return. A lot of people we work with love the idea of simply maximizing the IRR on a life insurance policy. And when that works best is with a lump sum funding scenario. It does depend on my age. If I am 40, I can fund a policy, call it over 4 years, that lump sum scenario. We're going to look at an example like that toward the end of this video with $250K per year, max funded, not a penny thereafter. Maybe I continue to pay the base premium, but at age 40, a 4-pay will look fantastic. If I'm 60 years old, I might want to spread that lump sum out up over five years typically. Could do 6 depending on my health. But if I want to maximize the internal rate of return, a lump sum funding scenario will typically accomplish that. Good to build awareness here. And then the last thing really is preference. You might want to fund for a long period of time, might be a short period of time. I'll let you know this because we often get the question like, what's better? And the answer is like, there's not really one that's better. If you want to maximize the IRR, a short pay is better, funding over 5 years. But here's what I would consider. If you fund a policy in 5 years to maximize the internal rate of return, and then we go reduced paid up, we don't pay anything else in, and we can't pay anything else into the policy, would you rather have a policy where you max fund it, call it for 5 years, and you have a 5% internal rate of return? Or would you rather have a policy where you pay into it for 30 years, maybe you have a 4.5% or 4.25% internal rate of return, lesser earning rate, but you're getting more money into the product? And this is where there's no right or wrong answer here. It is a matter of preference, our age. What's our situation? Everyone's different. Like everyone's different. We work with people in different companies. There's no answer to this question to say this is the best. Everybody goes back and forth here. So we're going to look at some examples here. What I want to start with though is the answer to this question, how long should I fund? Or if I ask, hey, how long would you like the ability, or how long do you want to pay into the policy? Number of years, certain age. Do you have an idea on that? If I get this back as an answer, I don't know, which would be my answer when I'm new to all of this stuff. I'm not going to design it in a manner that restricts someone to one option. To demonstrate that, what we're going to look at here is a 30-year-old individual with a policy where he has the ability to pay in $30K per year. I emphasize the word ability because he's not obligated to that. The minimum premium is going to be $3,000. We're going to look at the same company, same product, $30K per year for 10 years, nothing thereafter, then 30 years, and then 50 years. This will be the same company, same product, same design from day one. Now, I want to emphasize this point. When you design that policy initially, it's very, very important because if you want to make changes as the years pass in respect to your funding amount, the design, how it's set up from day one, is critical in respect to that MEC limit, that base premium. Do I have a term rider attached? Meaning, I can't model something day one, you start that policy, and then model something completely different with a higher or lower base premium down the road. Yes, you can make adjustments, but that is going to have an impact on the MEC limit and such. Having that design the same, so to clarify here, if this is you, a 30-year-old individual, you say, okay, I don't know how long I want to pay into it. Show me what it looks like if I pay in $30K per year for 10 years, but I can easily scale my payments back. But things might go well. Let's say I fund it up until age 60 at the same amount. I don't want to have to take out a new policy. I just want to keep on feeding it. Can I do that without a MEC, any of that good stuff? And then, hey, I want to build a huge legacy. Let's assume I'm going to go up until age 50. The answer is yes. Let's take a look. And then what we'll look at is our examples with the short pay and how to maximize the internal rate of return. Let's have some fun here. So what we've got here is the detailed ledger, the illustration. We're going to pull up the Excel spreadsheet, but I wanted to start here. 30K for 10 years, net cash value, year one, 26,211. Break-even point. So we see rich cash value up front. When's your break-even point here? Year 5. At that point in time, you've paid in 150 and you have 150. How we did that is we have a base premium of $3,000 in this example with the ability to continue to pay in up to 10x that, 30K per year, as long as we'd like. So here's where we can really validate that. Look at the year 10 mark, 347, 456. No payments thereafter. Okay, this guy right here, a lot of people ask this question, this annual surrender, that is your base premium that is still due, but you are not paying it. The policy is paying for itself through dividends and interest. Then we eventually go RPU, which stands for reduced paid up, meaning we kill the premium altogether. So year 10, 347, death benefit, 2.423. Keep those figures in mind, 347, 2423. Here's the 30-year funding option. Year 10 cash value was what? 347, 456. can rewind the video too if you want to cross-reference. I'm going to lay them out on Excel, but first just wanted to validate exactly what you're going to see via the illustrations. And the purpose of showing this is now you can see a policy where I plan to pay for 10 years, but things continue to go well. I can pay into it longer than expected. So we deliberately designed the policy where I can continue to feed the policy and I don't have to decide up front. Now the company selection is very important. If someone's very deliberate, they say 10 years or less is what I like. And maybe a little bit after that, but I want a lump sum, I am going to design it differently. But that comes in the conversation and such. But then here, we continue to pump into it for 30 years. And then we also have, I want to go to the Excel sheet shortly, but then we've got the 50-year option. You know what, before we look at that, 30 years, let's take a look. There we go. 30 years, what's your value? We don't pay anything in there after. 1.779. Death benefit, 4.611. So 1.779, keep that in mind. Let's go to the 50-year option. So same thing, year 10, 347,456, death benefit, 2.4. Scroll down, there's your cash value, 1.779. No mech, thoroughly mech tested it like we always do, very important with long funding scenarios. Here we go. Funding, total cash value, there we go. Payments going in, how long here? 50 years, up until age 80. And we can keep going here too. Almost $5 million in cash value based on the present dividend. Of course, things will change, especially over a long duration of time like that. So let's look at a simplified spreadsheet here to make this a bit easier. So this is simply going to put everything side by side. The three examples we just looked at, this takes the most important values. How much do I pay in each year? Annual outlay. Total payments, this will tally the total payments over the span of time you've funded the policy. Cash value, that's your money column, and then death benefit, what is paid out when we die. Really where I came up with that figure is based on the MEC limit more than anything else. So annual outlay, 30K, year one, 26,211. On each of the examples, what do you notice? It's all the same. What's highlighted in yellow, break-even point. So we're cash rich right off the bat. What's nice about this type of design is we've got rich equity immediately and strong long-term cash values with the ability to keep pumping into it. And if life happens, what's the minimum base premium here? $3K per year. Very low. So we're committed to a minimal amount. And after we fund it for a couple of years, you don't even have to pay that. And the proof of that guy right there. Nothing after year 10. So as we compare these guys, what do you notice? 10 years in, there's the 347 in cash. You say, okay, after 10 years, I'm 40 now. I've got other things going on. I'm content with this policy. I still want to borrow from it, repay the loans, use it as a personal line of credit, if I want to call it that, for my business, but I don't want to have to pay anything else in. Or it's just 3K per year. You could do that, but let's assume nothing. Progress on to the next guy. You say, you know what? I want to keep on feeding this. Maybe you stop at 45. Maybe you stop at 50. Here, we stop at 60. All right. So 60 years old. Not a penny in thereafter. You have paid in a total of $900,000. Got almost 1.8, 1.779. Scroll your eyes to the right. Is there any difference here at the year 30 mark? None whatsoever. Same input, same values, because it is the same policy. And we pivot as we go and say, hey, I want to keep on feeding it in this example. Some people are attracted to this. If uncertain, hey, what option should I go? The company selection, as I mentioned earlier, is very important for transparency. This is a MassMutual illustration. This is their strength, where if I want to fund, call it with that minimum premium design, maximum PUA allocation, cash rich up front and long term. If you design it properly, can avoid a MEC and it looks very, very, very good over time. and it's easy to maintain as well. But if you're not familiar with MassMutual's flexibility terms, I would check out our All About MassMutual video, or just reach out to us and we can always send you a quick, short answer to it too. By age 80, there you go. Now you have a large death benefit that's going to be left to the next generation as well. You're doing all of them, but here you kept pumping it up. And maybe you keep going until age 100. Some people like to do that kind of stuff, where they have a trust continue to fund the policy. When you look at the family office concept and what a lot of families do with generational wealth. So really interesting. So this really was meant to touch on how long can I fund the policy, and then how long should I fund the policy. Let's touch on real quick a short pay, because I'm attracted to this, and a lot of people we work with are attracted to this, where they say, hey, I love the idea of what I can do with the cash value, safety, liquidity, the tax benefits, but I hate the idea of the word whole life insurance. I do not want to have to make payments for my whole life. And don't try to sell me on the fact that it's a good idea. We have people that say, hey, here's how long I want to pay in. So my thing from a business perspective is show all the options, but at the same time, answer someone's question directly. So no problem, Mr. Consumer. Here's an example for a 40-year-old male with a $1 million lump sum. Now we're going to have a more recent case study in the future for someone we just worked with in this situation. I had a lot of fun designing the policy with him, but it looked a lot like this. We just looked at a variety of different products, more with cash up front, greater long-term IRRs with different options. But anyway, before I ramble more, between years 3 and 4 is your break even in this particular example. These are non-guaranteed values. We have the guarantees, and we've covered this in different videos too. But there's your annualized IRR, not the average, very strong over time. If you're going to short fund a policy and look at reducing the term rider, a reduced paid up option, if you've seen any of our how to maximize IRR videos, we really go through that thoroughly. Like this is what will do it. But what you sacrifice with that, to be very, very clear, because the earliest you can kill the premium with that reduced paid up is after year 7, you sacrifice the ability to continue to add money in. So as long as someone has awareness on that, like that's the big thing. It all depends on our preference, really, at the end of the day. Now, we've got someone who's a little bit older, 48 years old, wanting to pay in a total of $1.5 million. This was based on an actual case. What this individual ended up doing, actually, we designed the policy a bit different because he wanted to pay in not just for 5 years, but for 10 years. And then nothing thereafter. He said, hey, in 10 years, I'm going to sell my business. I'm going to sell my practice. I'm not going to have to pay anything in. Maybe a little bit, but I'm not going to be cash flowing in at 300 grand per year. This was also designed with a ton of flexibility. They're committed to about 10% of this. That's what they pay annually, and then just pour more funds into PUAs at discretion. So they had a flexible company, and it was 10 years or less. Like that was the goal. You know, they came explicitly, this is like what we want. How can we accomplish this? So we showed them a number of options, but here we go. 1.5 total in this model. Nothing thereafter. How's that cash value look when you look at the IRR on the right? And the IRR, so that's the annual internal rate of return, that's the net growth rate after the company's insurance expenses, mortality charges, all of that good stuff, which is good to see. That's not the average. We've got other videos that go through that. So I hope you enjoyed this, I'm going to call it case study, cash value Q&A session as far as how long can you pay and how long should you pay into a policy. Really, just to answer the question to the best of my ability, can, as long as you want. How long should? Matter of preference, up to you. See the different options, what do you prefer? And if the answer is, I don't know, see a variety of options, kind of like what we just looked at there, and equip it where it's very, very flexible, where you don't have to know up front. And we can pivot as we go. It's just really understanding the different companies and products and limitations and what's available. So if you like to work with insurance nerds that sit behind the table and kind of type everything out, feel free to reach out to us anytime. All of our agents are well versed in this, along with all of our staff. And I'd always be happy to connect with you. So if you did enjoy this, please hit the like button, subscribe for more, and hope this helps. Talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.